Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 855A, and today's date is December 30th, 2015, and the title of the episode is IMF Now Admitting Economy Not Going to Improve in 2016, Prepare for the Collapse. Now, before I get started, I just want to make two announcements. The videos on YouTube, they have blank spaces at the end. This was a problem with the software, but it's solved now, and we shouldn't have these problems as we go forward. And for those people who told me about the problem, thank you very much for letting me know. It's nice to have another set of eyes looking at this and realizing that something is wrong. The other announcement is tomorrow, December 31st, is going to be a news brief. There'll be no report on New Year's Day, and I will continue with the normal reports after New Year's. Let's get right into the economic collapse financial news. Now, the United States government central bankers, they're going to do whatever they possibly can to make this economy look good. And they have been throwing manipulated numbers at us for a very long time, trying to convince us that everything is fine. And we are seeing that Case-Shiller came out yesterday talking about how the prices on housing is continually rising. And of course, this data that they're providing is from 2 months ago. And we've seen going forward that the data is not showing that housing is going well. Actually, a lot of the data that's coming out is showing us that the economy is headed towards a major collapse in the system. And we've been going through this collapse for quite a while. And we see now that the new home sales basically disappointed. Existing home sales crashed in November. And now we're seeing pending home sales. They have plunged by 0.9%. And they thought they were going to have a rise of about 0.7%, and it actually went the opposite way. Now, of course, this whole entire thing makes no sense because Case-Shiller on the corporate media is telling us, that everything is fine, housing prices are continually going up, but there's no one purchasing the homes, which makes no sense whatsoever. And this is what we're seeing. Realtors are now saying people are getting nervous because of what the Fed has done, and people now are not going out and looking to purchase a home, and they're finding that a lot of people saying, okay, that just kicked me out. I'm going to wait a little bit to see what happens. I'm not rushing into it. And they're saying that this is affecting the real estate market. Now, does it really have an effect right now? Or is it that a lot of people are being laid off? I know that a lot of people with family this week. I am with family this week. And the stories that I'm hearing where people are being laid off from Sony, from accounting services, they're all being laid off and they're getting very nervous, or they hear rumblings of layoffs in the companies and they're getting very nervous. And we can see as we move into 2016 that the economy is going to continually head downward. And we're getting indications that this is where we are headed. Now, we have to remember this entire system is inflated into one gigantic bubble. Yes, there's multiple bubbles like the student loan bubble, the treasury bond bubble, the stock market bubble, the derivative bubble, the housing bubble. You name it, we have a bubble for it. And what we're seeing right now, all of this has been created by the central banks. All of it is being propped up, and it's going to come crashing down. Now, we realize that the derivative bubble is absolutely gigantic. And the United States has an incredible amount of exposure, and I'm talking about the banks in the United States, to derivative contracts. They exceed over $30 trillion. And the U.S. banks, the biggest U.S. banks, collectively have more than $247 trillion of exposure to derivative contracts. That is an amount of money that is more than 13 times the size of the U.S. national debt. And it is a ticking time bomb. And globally, what we're seeing is that these derivative contracts, they are a staggering $552 trillion. And this is according to the Bank for International Settlements. Now, a derivative is a security with a price that is dependent upon or derived from one or more underlying assets. The derivative itself, it's a contract between two or more parties based upon the assets or assets. Its value is determined by fluctuations in the underlying asset. The most common underlying assets are stocks, bonds, commodities, currencies, interest rates, market indexes. And when we look at the derivative market, it's basically like a legalized type of gambling. And these banks, their exposure compared to the amount of assets they have are amazing. Take Citigroup, for instance. Their total assets is about 1.8 trillion. Their exposure to derivatives is about 53 trillion. JP Morgan, their total assets is about 2.4 trillion. Their total exposure is about 51 trillion to derivatives. Goldman Sachs, their total assets are about $880 billion, a little bit less than a trillion. And their total exposure to derivatives is 51 trillion. Bank of America has about 2.1 trillion in assets. Their exposure to derivatives is 45 trillion. And this goes on and on and on. So there's a huge amount of exposure. And we can see when this system falls apart, it's going to be a domino effect, and it will bring down each one of these banks. And this is why they have the bail-ins set up and ready to go. This is why come January, the European banks, European countries, are supposed to have their bail-in documents ready to go. Now, there are certain countries that are still fighting this, saying that we're not going to do this, but they want everyone in line for what is coming. And what is coming? Well, that is the collapse of the entire system. You do not put all of this into place unless you're expecting something to occur. And we have been seeing bail-ins in Cyprus. We've seen it in banks in Italy. We know Greece is getting ready to do bail-ins as soon as 2016 hits. And Portugal right now has announced for the second time in less than 2 years some type of bail-in. This time around, it was BANF, the country's 7th largest banking group, which ran into trouble and it couldn't repay previous government cash injections. So what do? Well, they have a bailout for the bailout that they had, and then they turned inside and they're going to go after the people's money, which is called a bail-in. And we know this has been done in many different areas, and they are preparing to do this across Europe, in Canada, in the United States, and many other countries. Because they realize when this system comes crashing down, they'll have no alternative but to go ahead and take the people's money and give them worthless bank stock. Why would you want a piece of paper from the bank if the bank is failing? It makes no sense whatsoever. What do you do with it? You can't do anything with it. And we're going to see this happen most likely in the near future. Now, we understand the IMF makes a lot of predictions. They tell us that, everything's going to be great. And then all of a sudden, everything doesn't turn out to be that great. We see Christine Lagarde is now saying that the global economic growth will be disappointing next year, and the outlook for the medium term has also deteriorated. So what is she really saying? She's really saying it's going to be a lot worse than we really predicted. Now remember, when they tell us that they're going to see 3% growth globally, they always take that and it goes down to 2.7, it goes down to 2.5, and they keep dropping the numbers. Now they're already telling us it's going to be disappointing. We're seeing things start to deteriorate. What this tells us is it's going to be a lot worse than what they're saying. And they're saying the prospect of rising interest rates in the United States and the economic slowdown in China, they're all contributing to this uncertainty and higher risk of economic vulnerability worldwide. It has nothing to do with the central bank. It has to do with everything else. And they're saying the spillover from the Fed hike and everything else is going to hit the emerging markets, and they're going to be put into a huge amount of risk, and there's going to be problems there, and this is going to spread throughout the global economies. And what we're seeing right now, because normally when the IMF comes out at the end of the year, they tell us how great the next year is going to be, how we're going to see incredible growth. Well, of course, towards the end of the year, they completely backtrack on all of that. Now they're telling us it's going to be a little disappointing, which tells us it's going to be a lot worse. And we all need to be ready for this. Because as we know, that this system, everything that we've been looking at, retail, real estate, GDP, the real unemployment, the derivative market, the smackdown of precious metals, what's going on geopolitically, it is all leading up to one thing, and that is a complete and utter collapse of the system. And this is where we're headed right now. In the new spending bill that the United States passed, of course it included CISA, which President Obama said he was going to veto, but of course he didn't. We see that they have given away the voting rights to the emerging markets, and they will have additional voting percentage to vote and veto whatever the IMF comes up with. So the emerging countries now, including China, Russia, they will all have the power to veto decisions by the IMF, compared to before when the United States had most of the voting power. So right now, we see that things are being shifted from the West over to the East. And we see at this point that the BRIC countries are going to have more power now in deciding their fate. And at this point, as we get closer and closer to the collapse, the U.S. government, the central banking system, is going to do whatever they possibly can to make sure that they're not blamed for what is coming. And how do they do this? Well, they create something where all eyes are off of them, and it puts it on other countries or groups. So what does everyone have to do at this point? Well, you need to continually prepare for this. Now, I'm not telling you to be afraid. I'm not trying to scare people. It's like a weatherman saying there's a hurricane that is approaching. And, it could hit, it couldn't hit, but it is heading right to us. And you need to have batteries, you need to have food, you need to have water, you need to make sure you have a generator. As the storm gets closer, they tell you, yes, it's coming. It's not here yet, but continually prep for what is coming. The storm's getting closer. Make sure you're still doing it. Now, there's certain people that are going to say, oh, they're trying to scare us, nothing's going to happen. And then finally, the storm does hit. Those people who were listening, prepared. Those people who didn't listen, they're running around trying to figure out what to do next. We saw this in Hurricane Sandy. We see it in many different storms that hits. This is a storm that is heading our way. The United States government central bankers have been holding on to this storm, trying to continually push it off until they get everything prepared and ready for themselves, for their system. And once they have everything ready to go, and you're not going to blame the U.S. government, the central bankers, they will let the storm hit. And we can see the storm is getting bigger and bigger, pushing closer and closer, and before you know it, they will have no control over it. So it's either they're going to bring it down themselves on us, or it's just going to hit and break through whatever they're trying to do, and they'll have no control. But what you need to do is continually prepare for what is coming. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.